Are you ready to turn your home buying dreams into reality? Let's tackle 6 important steps to buying your dream home. Make sure to stick around to the end because step 6 will surprise you. I'm Blake Alewelt, owner of the Bravo Ridge Group, and in this video, we're going to share one of the most important parts of buying your next home, getting a mortgage. Out of the entire home buying process, getting a mortgage is perhaps the most intimidating step. You're convincing someone to hand you hundreds of thousands of dollars. So how do you pull it off? Number 1, should you work with a bank or a broker? The majority of home buyers get their mortgage directly from a bank, often the same institution where they have their primary checking and savings accounts. But that's not always the best option. Shopping around with different lenders may land you a better deal, typically in the form of lower interest rates. Or you can choose to hire a pro, a mortgage broker. Brokers work directly with lenders to negotiate the terms and determine the best loans for you, taking into account your needs, income, savings, and any special situations that might apply. For instance, first-time home buyers might have just landed a better job and received a raise, which offers more buying power than it shows on your last 2 years' tax returns. The right broker will be able to find loans that take just the past year's returns into account. But what's the downside? Well, brokers do charge a fee, typically 1 or 2% of the cost of your loan. While many receive this fee from the lender, they might also charge you a little bit of it too. Still, if your financial situation is complex or you lack the time to do your own research, paying a broker could be money well spent. When I'm looking for loans, I will get quotes from a few different credit unions and brokers and choose whichever one best fits that current situation. Number 2, how long do you plan to live there? For most people, the choice comes down to 2 main types of loans, fixed rate and adjustable rate mortgages or ARMs. True to their name, fixed rate mortgages offer home buyers an interest rate that remains the same for the life of the loan. Adjustable rate mortgages have an interest rate that is fixed for an initial period, say 5 years, then adjust at regular intervals, typically 1 year, to reflect the market indexes, which means that your payments will fluctuate too. I myself never choose these due to the risk, especially after what just happened in the last few years with rates climbing so fast. Many people are in for a world of hurt when their mortgage payments increase thousands of dollars. If you are like me and prefer predictable payments and or planning to stay in the home for longer than a decade, a fixed rate mortgage may be better. Your interest rate remains stable regardless of market conditions. Other than property taxes and home insurance, your payments will be the same every month so you can plan your finances. Now, there are times when it makes more sense to get an adjustable rate mortgage. For one, the starting interest rate for this type of mortgage is often a full percentage point lower than a fixed rate, which can add up to substantial savings. And even though the payment will fluctuate at some point, that can be as far out as 10 years down the line. If you're expecting your residency to fall on the shorter end of the spectrum, an adjustable rate mortgage might make total sense for you. Number 3, what monthly payments can you afford? Most residential mortgages offer 2 loan periods, a 15-year and 30 years. A 15-year loan offers a lower interest rate but higher monthly payment since you're paying it off in half the time. Conversely, a 30-year loan offers lower monthly payments, but you'll wind up paying more interest over those 30 years. So which one is right for you? That depends on what you can afford. Try using a mortgage calculator and plugging in your numbers. All you'll need is a location, the home's price, and how much you plan to put down for the down payment. You can toggle between 15-year loans and 30-year loans to see how your expected monthly payment would change depending on the term of the loan. If you want to know a neat trick, banks will hate me for saying this, but there's something called principal-only payments. These are additional payments on top of your normal mortgage payments that you make, but they pay down the principal only and do not go toward the bank's interest. This way, you're not obligated for those bigger monthly payments like the 15-year loan, but just when you have the extra cash. Number 4, do you expect your financial situation to change? If you're expecting major incoming changes in your financial situation, whether good or bad, make sure to take those issues into consideration before deciding on a loan. For instance, a major increase in your income might mean an ARM is the best product for you, providing low payments for now and more rapid repayment as your career takes off. Anticipating a lump sum payment soon? Same thing. An ARM lets you pay less now and aggressively attack your principal balance later. On the other hand, if you're concerned about your job stability, go with the fixed rate. As always, discuss the plans with your loan officer to see which option is truly the best for you. Number 5, should you lock in your rate? A lock allows you to lock in a specific rate for a specified length of time before closing. This protects you if interest rates go higher, like what they've done in the past few years. A float down is an extra feature that can be added to a lock. It allows you the flexibility to get an even lower rate if rates happen to retreat after a lock is set. These features require a fee, but depending on the volatility of the market and how critical it is for you to keep down your monthly mortgage payment, that cash could be a worthwhile investment. Number 6, can you negotiate anything? You may not have much luck negotiating the interest rate or the terms of the loan, but there are other areas where lenders might be willing to wiggle. Ask for an itemized list of expenses and see what's up for debate. Pay attention to the little charges. Do you see a courier or a mail fee, but you did everything electronically? Those fees may be pretty standard for a lender. Now they can be waived. Lenders might also be willing to waive the application fee or pay some of your closing costs, decreasing your overall cost. Mortgage brokers can be extra helpful here, so make sure to talk to them about lowering any additional expenses and fees. That wraps up part 8 of the complete guide to buying your next home. Don't forget to hit the like and subscribe buttons down below, because in part 9, we are going to cover the more intricate pieces of buying a home. In the meantime, I will leave my contact details in the description below, so if you have any questions at all, please feel free to reach out. I look forward to hearing from you.